So my thesis is on evidence of redlining on lendingclub.com. And I thought I would start with just a little background on the study. I did my pre-thesis research during money and banking class with Professor Nodell, and I was focused mainly on fintech, financial tech research overall. So I looked at crowdfunding, point of sale technology, and peer-to-peer technology. And I ended up narrowing down to peer-to-peer lending for a few reasons. One, I was really interested in the secondary market. So on Lending Club, you can invest in a portion of a loan and then turn around and immediately sell it to someone else. You don't have to hold it for the entire life of the loan, which I thought was interesting. Also, the exponential growth of global peer-to-peer lending. So in 2018, it was forecast that there would be an over 50% compound annual growth rate through 2025. And I think that, in finance, whenever you see explosive growth like this, that should kind of raise a red flag and tell people that maybe we should be looking into this a little bit more. So that was of interest to me. And then also the democratization of the lending process. Traditionally, it's been that one institution or entity has control over all aspects, be that approval of the loan, funding of the loan. And this kind of breaks that apart and gives individual retail investors a little bit of power, which I thought was very interesting. I chose Lending Club specifically because it provides the best data set by far of any of the peer-to-peer lenders in the US. So my main research question is, how does Lending Club accept or reject loans based on the racial composition and redlining history of different geographic regions? So I think it's important to note that I do not have race as an independent variable. Lending Club does not collect data on race. So what I'm doing is using the population characteristics of different locations as a sort of proxy for race. And so it's important to think of what I'm doing as kind of slicing up the geography into chunks and comparing them, as opposed to dividing up borrowers by race and comparing them. I think that's just an important thing to keep track of. I have a few related questions that I also seek to answer. The first of which is, do differences in charge-off rates explain the differences in approval rates between geographies? So this is my second stage research question. And the idea here is that if I find large approval discrepancies, but then I turn around and look at charge-off rates, and I find that the group that was less likely to be approved is way more likely to charge off, then you can kind of see where that effect is coming from. And so that was the goal. That's the goal of my second stage research. I also seek to understand if Lending Club provides predominantly minority and historically redlined geographies with significantly higher interest rate loans. So my research is based on other research that was done after the Home Mortgage Disclosure Act became law. And one of the things that the data from that act really showed us was that there are a ton of subprime mortgages in African American communities. And nobody had any idea how many there were. And these peer-to-peer platforms are claiming to be improving the system as a whole. So this is just one way of checking, are they giving expensive or bad loan products to people in these geographies? Another kind of my final question is comparing Lending Club financial accessibility with the banking sector. And so this is where I look at the research that's already been done using the HMDA data, and I kind of compare it with this. And this is just because I need a sort of benchmark, right? Obviously, I don't think it's realistic to think that peer-to-peer lending would completely solve financial accessibility problems, but this allows me to have a benchmark to kind of measure how they're doing. So my research deals specifically with redlining, but I think it's pretty important to go over some of the overall benefits and drawbacks of this model first. The benefits of peer-to-peer include a really easy application process. You're accepted or denied in 20 minutes. No in-person interaction with a potentially biased bank officer or loan officer at a bank. Lots of investors with differing risk attitudes, which means that Lending Club can fund a whole loans for a whole groups of people with differing credit worthinesses. Basically, they can shuffle investors based on their risk attitudes and provide a wider range of loans. And then they can also restructure debt into a single fixed rate loan. They have a very easy process for that. And then obviously coverage of remote areas where there might not be bank branches. So the drawbacks of peer-to-peer, the main drawback is moral hazard for the platforms. And so basically how this works is that before Lending Club instructs its banking partners to originate a loan, it makes sure that it has the demand from investors to buy that loan. Lending Club never seeks to hold the loan. And so what this means is that if people default, the investors are left holding the stick, and Lending Club is fine. So there isn't really incentive for them to be improving their credit scoring algorithms and their loan grading algorithms. And that's where the moral hazard comes in. And on a related note, if a lot of these loans were to start to default, then maybe investors would start to realize, oh, we don't actually know what goes into this proprietary loan grade, and it doesn't seem like it's reflecting the true risk of these assets. And then you could have investor panic, which would be a big systemic risk. And additionally, just these proprietary systems that they use add a level of uncertainty. So I'm going to go on to talk a little bit about the literature, but basically, if you're looking at discrimination on peer-to-peer platforms, you have to either look at discrimination by the investors. So I'm going to fund this loan, I'm not going to fund that loan, or you have to look at discrimination by the platform itself. And for obvious reasons, there's a lot more research surrounding the individual lender discrimination, and I'll give a few examples. One study that was pretty interesting looked at discrimination through profile photos on Prosper, which is the second largest peer-to-peer lender in the US. And basically they found that if you were clearly African American in your profile photo, then you were significantly less likely to receive funding. There was another study that looked at the loan description, which is just where you write about your loan as a means of signaling for low creditworthy borrowers that allows them to kind of connect with investors in a way that they wouldn't have been able to otherwise. And then another study looked, this was only in China, but they found that investors were very biased towards entrepreneurial loans as opposed to salary earner loans, which should potentially raise some red flags because I think entrepreneurial loans by and large are a little riskier. So on the other side of this, discrimination by the platform itself, there really is not much research because of all these forms of alternative data that Lending Club and other platforms use. I did find one very interesting article that basically looks at the proprietary Lending Club loan grade, and it looks at the correlation between that and the borrower's FICO score. And they found that back in the beginning, early years of Lending Club's history, the correlation was roughly 80%, and in the later years, it's fallen to 30%. So what this tells us is that Lending Club is pulling over time additional sources of data in order to make these decisions about approval, about interest rate, about loan grade, and it's not completely clear how they're doing it. And I will continue to talk about alternative data throughout this presentation, but I just think that's an important note. So for my data, I have roughly 30 million loans, all of their accepted loans ever, all of their rejected loans ever. And then my variable of interest is the zip code prefix. So I'm given the first 3 digits of the zip code for every loan. And basically this corresponds with a mail sorting location. For controls, I have credit score, debt to income ratio, employment length, and amount requested. And I think this is a pretty good control set for this study. The one thing was that credit score, depending on what year the application was in, they either pulled your Vantage score or your FICO score. And there's no perfect way of transforming between those two because they're both proprietary. So I had to basically scale the Vantage scores down to the range of FICO scores, 0 to 850. So here we're going to kind of look at how the controls change your probability of acceptance. Here you can see credit score, and this is a log scale. But basically what you can see is that up until around 600, you basically have no chance of loan approval, which makes sense with how Lending Club chooses to approve loans. The other thing that you see here is basically the full range of credit scores. Your probability goes from basically 0 to basically 100. And this highlights how credit score is by far my most important control variable. here we have debt to income ratio. It's a similar story. Here you can see, though, that for the entire range of debt to income ratios, your probability of acceptance only goes from like 3% to like 11%. And so you can see that this doesn't have quite as big of an impact on your probability of acceptance. The other thing you can see here that I should point out that I'll talk about later is that you can see nonlinearity in these graphs. You can see that there is not a linear relationship between the probability of acceptance and these control variables, and that will be important later. So here's the same thing with employment length. You can see again, it is nonlinear. And then here I will explain my geographic variables. So I define 3 different geographic variables using those zip code prefixes. And the first 2 use data from the American Community Survey from 2018. That's where I got my data from Social Explorer, which Professor Cope introduced me to. So here you can see the African American indicator, and what you see in red is the zip codes that were given that indicator. And I set the threshold for this indicator at 80%. And you might be wondering, that seems really high. That doesn't look like a lot of zip codes. Why so high? And basically the reason is that these are full zip codes. And so there's a sort of lack of precision problem with me only having the first 3 digits. So you can imagine that any zip code surrounding these red zip codes that has the same prefix as any of the red zip codes will also be in this indicator. So you can kind of imagine a larger area surrounding these red dots, and that's what the actual indicator would be. And there really isn't a way for me to fix this lack of precision, but these variables just basically had to be developed under the assumption that an area right next to one of these 80% areas probably also has above average African American population. And that's just kind of the assumption that was required in order to deal with this precision problem. So here you can see the same thing, but for Hispanic Latino, you can see it's the same threshold. So it's a similar number of zip codes, and you can see that it's kind of the other side of the country. All right, so my third binary indicator is historically redlined, and the goal of this variable was to capture the effect of living in an area that isn't necessarily redlined right now, but has a history of being redlined. And so the Homeowners Loan Corporation residential security maps are used for this indicator, and zip codes that were given a hazardous rating are the ones that are given the historically redlined indicator. So I'll just show you really quickly. Here's a map of the cities where these maps were drawn, and the size of each circle is the proportion of area in that city that got each grade. So just going back, there are a few kind of confounding elements to the historically redlined indicator. One is that these maps were only drawn in major cities, and so the effect of living in a major city is kind of tied up in this indicator. And one potential extension, a way of solving that problem, would be to look specifically only at a city and to look at the hazardous versus non-hazardous areas and compare those. But when we're zooming out all the way, there is that confounding effect here. Additionally, these maps were drawn roughly 90 years ago, so things could have changed. Gentrification could have happened in certain areas, and the average creditworthiness could have increased, things like that. One thing that made me feel better about this variable is if you look at the characteristics of these hazardous areas now. So 74% of the hazardous areas remain low to middle income 90 years later. 64% of them remain minority neighborhoods, and 91% of the best areas remain middle to upper income, and 85% of those areas remain predominantly white 90 years later. So this shows, things may have changed. There are some confounding effects in this variable, but there definitely are effects that can be seen of the systemic redlining even 90 years later in these areas. And just going off of that, here's my correlation table. And my second largest correlation is between African American and historically redlined at 0.26. And this, again, just kind of validates the premise of that variable a little bit because, I'm taking these different routes to try to identify geographies that have been redlined or are likely to be currently redlined. And the fact that taking different paths to get there, some of them overlap, I think is a good sign. All right, so this section is Professor Gibson, I know that you wanted me to talk a little bit more about the specifics of logistic regression, why I chose it as opposed to linear probability model, and how the transformations were taking place. So I added that to the paper, and I also just thought I'd explain a little bit here. So basically, the functional form can be linear or nonlinear. I originally chose logistic regression because that's what Stock and Watson do in their HMDA research that I was basing this off of. But going back and digging a little deeper, I've kind of uncovered that actually logistic regression is a very good functional form for this. So on the left, you see the linear probability model. And one thing I learned is that you can see the area kind of in the middle from like 20% to 80% is basically straight in both graphs. It's basically linear, right? So for those kind of moderate probabilities, when you're trying to predict them, the log odds of the probabilities, that's the logistic side, and the probabilities themselves basically have a linear relationship. And so it doesn't matter as much in those kind of medium probabilities. But when you get to the extreme probabilities is where you see this curvature, and that's where logistic regression can really make a difference. And long story short, basically, we already saw some nonlinearities in those control variables. So we already kind of saw how this is maybe not perfectly linear. But also, I'm modeling probabilities that are, a lot of them are under 1%, and all of them are under 20%. And so I'm really down in that bottom left-hand corner where the curvature of logistic regression really gives you the upper hand. And so that's the reason that logistic regression was chosen for this study. And here, this is just kind of some basics. At the top is the general logistic regression equation. So you have the natural log of the odds ratio as the dependent variable. If you solve that for p, you get the second equation. This is how I transform my regression coefficients into predicted probabilities. This is how I say you have a 10% predicted probability of acceptance. And then on the bottom, there's a model regression equation from this study with my variables and my controls. So on to some results. So this is my major results table. And I should just kind of, I'll preface this here. I look at specific years of Lending Club's history in addition to every year of their history together. And the reason for picking specific years was because they got founded right before the 2008 financial crisis. So they have really had, the economy has had a wild ride during their lifespan. And so it felt important to pull out a recession year and some expansion years just to kind of see how things changed over time. So what you can see here, this first column where it says all zero, that is if you are not from an African American or a Hispanic or a red line geography. That's if you're not from any of my indicators. And you can see that if you go down the African American column, in every single year, in every single specification, you have a lower probability of approval. Every single specification, every single year. You can see for Hispanic that in the first one, in 2009, they actually had the exact same probability as the all zero column, but then they had consistent negative effects as well. And then for redlined, there were actually a lot of positive effects in the individual years, which I'll talk about a little bit more, but I think it has to do with kind of the confounding effects of that are tied in that variable. So looking at kind of the years overall, African American consistently has the largest effect, and it's negative across the board, except for if you look at all years together. And when I look at all years at the same time, then African American is still negative, but it has a smaller effect than Hispanic Latino. Hispanic Latino also has a consistent negative effect, but it has the largest negative effect when you're looking at all years together. Additionally, redlined has a mostly positive effect, which again, is a little bit confusing, and when we get into the charge-off rates, it'll become even more confusing. And then the inclusion of my controls dampens the effects of my binary indicators. That's completely normal, completely expected. But in my specifications with only my indicators, the coefficients are a lot larger due to omitted variable bias. Right. So just kind of looking at how things have changed across years, this is the percent of loans accepted on Lending Club. And initially, I had expected a kind of loosening of credit over time as they got their feet under them, as they figured out this new form of lending. But that's not what you see. You see this dramatic decrease from 2015 onward. And so there's kind of two explanations for that. One is that they raised their standards. They expected higher creditworthiness. But then I was like, okay, well, the other thing that could be causing this is that the average creditworthiness of borrowers just went down over time. And that's what this shows you. So you can see that amount increased over time, bad for creditworthiness. Debt to income ratio increased over time, bad for creditworthiness. Employment length decreased dramatically over time, which is also bad. And then credit score remained pretty much consistent, maybe a tiny bit higher. But what you see here overall is that there was kind of, and this is very weird because my first year is 2007, but you kind of see a worsening of credit throughout the expansion years as well, specifically at the end from 2016 to 2018. Right. So now on to my second stage results. And these results, this is where I'm looking at the probability of charge-off. And so if you are not from an African-American geography, not from a Hispanic Latino, not from a historically redlined, you have a 10.71% chance of your loan charging off. And that percent is higher for each of my indicators, and it's the highest for the historically redlined indicator. And this was where I was saying things were going to get even weirder, because despite having positive effects in my individual years, as in you live in this area, you're more likely to get approved. If you live in this area, you're significantly more likely to have your loan charge off. So it seems kind of weird, and I'll discuss that a little more later. So the main point of the second stage results, those numbers by themselves, they're informative, but they don't really tell us much, is to measure the magnitudes of the charge-off discrepancy and the acceptance discrepancy and compare them. So these are the percent changes from the all zero indicator. So if I go back here, this 4.2 you see for African American, that's because 11.17 is 4.2% higher than 10.71. So we're looking at the magnitudes here. And what you see is that for people from predominantly African American geographies, you have a 4.2% chance of your loan charging off, and a negative, or I'm sorry, you're 4.2% more likely to have your loan charge off, and you're 1.2% less likely to be accepted. So this is actually somewhere where I made a mathematical mistake in earlier versions of the paper, and I've fixed it. But basically what this shows us is that it doesn't really seem like there's anything that bad going on with the African American approval discrepancy when you look at charge-offs. It looks like there could even be a bigger approval discrepancy, and it would still be explained by the higher charge-offs. So that's interesting. But where things really get interesting is Hispanic Latino. So if you're from these geographies, you're 3.1% more likely to charge off, but you're 6.17% less likely to be accepted. So this is where you kind of look at this and you step back and you go, okay, something's going on here. There is, the charge-off discrepancy does not explain the acceptance discrepancy because it's so much smaller in magnitude, basically. And I'll talk more about this later, but this is kind of an important finding because it just shows that these charge-off rates are not doing a good job of explaining the discrepancies in acceptance. And then for the historically redlined indicator, you have basically the same thing as the African American indicator. It's important to note that this is pulling data from all years. So the African American acceptance discrepancy is bigger in the individual years, but for the all years, it's not quite as big. And then the same with historically redlined. This negative 1.2% is actually positive for most of the individual years, which would make this even weirder. But even how it is right here, you would assume that they would have a larger approval discrepancy based on how many charge-offs they're having. All right, so comparing kind of all these results to the banking sector, Stock and Watson, when they did their research, they uncovered basically a 2-to-1 rejection ratio. You're twice as likely to be rejected if you're African American. And one of the original problems with HMDA research was that the law didn't require banks to report variables that control for credit. So all that was being reported initially was race and location and like some very basic loan information. And so there was a ton of omitted variable bias when people were trying to create these regressions. And that, they found these huge discrepancies. And then the banks basically said, you didn't control for creditworthiness. So the Federal Reserve Bank, I believe, of Minneapolis, went out and collected all of this data, credit controlling data, and they redid the study. And they found that the rejection ratio shrunk, but it was still significant and it was still very large. It shrunk from 2-to-1, but in both cases, the discrepancies that this HMDA research is leading to are way larger than any of the discrepancies that I found, significantly larger. So, using this kind of as a benchmark, even though I am finding these significant and consistent discrepancies, it doesn't look like Lending Club is really making things worse. All right, and now we go on to interest rate results. And the goal of this, I'll just reiterate, was to see if they're flooding these geographies with bad loans, with expensive loans. And long story short, they are not. So these are just the coefficients, these red numbers. So if the interest rate for somebody who wasn't from an African-American geography was 10%, the interest rate for someone from an African-American geography would be 10.14%. So these numbers are tiny. And this was pretty surprising for me, the fact that interest rate, basically, there aren't any discrepancies overall if you control for credit, which I think is a good thing for them. All right, and then just kind of reiterating overall results, consistent negative effects for African American and Hispanic Latino, consistent across the board. The creditworthiness of applicants decreased with time over the course of Lending Club's history. And this might be a reason that the percent of loans accepted was lower in later years. That also decreased with time. And then the African American approval discrepancy varies greatly between individual years. It's always negative and it's almost always significant, but the magnitude does vary depending on what year you pick. And I think this is just due to the fact that some years, like the population of applicants is different from year to year. And then the African American approval discrepancy is greater in the selected years, 2009, 2014, and 2016, as opposed to all years taken together, which is just kind of interesting. For my stage 2, Hispanic and Latino charge-off rates do not explain approval rates. And I think this is the main conclusion to be drawn from this. I think overall, the charge-off rates do not explain the approval rates, but especially for Hispanic Latino, that was kind of the result that I was looking for, where you go, okay, this needs to be dug into more because there's just isn't any clear explanation based on what I've done for why that would be the case. And then for interest rate results, African American is associated with the largest rate increase, Hispanic Latinos associated with a decrease, but I'll just reiterate, the numbers are so small that they're basically nothing. So approval discrepancies are significant and consistent, and I mean consistent in sign. They're not really consistent in magnitude. They do change with time. Approval discrepancies are significantly smaller than the 2-to-1 rejection ratio uncovered by Stock and Watson. Charge-off rates do not appear to fully explain approval discrepancies, and Lending Club is not charging disproportionately high interest rate loans to these communities. So those are kind of the major results and answers to those questions that I laid out earlier. And I know, Professor Gibson, you also thought that there should be a discussion of internal and external validity in my paper, and I added that, and I just thought I'd go over it a little bit here. The first threat is omitted variable bias, and 2015 does pose a significant threat as far as this goes, and that is because I had to drop credit score as a control due to what's called a non-convergence problem in logistic regression. Just something to do with the data would not allow the function to converge. And so in 2015, there is no credit score. I also ran into the same problem in 2016 and looking at all years, but I was able to keep credit score by dropping either employment length or debt to income ratio. And because credit score is by far the most important control, I think, you can basically look at every year except 2015 and look at a specification that includes credit score. And for that reason, I think 2015 just needs to be taken with a grain of salt, and the lack of controlling for credit score is the reason that the predicted probabilities are so much higher in 2015. So the second threat to internal validity is functional form misspecification, and I talked about this earlier with the logistic model, but you can see with these graphs down here the nonlinearity, and then again, just intuitively, it's really hard for me to believe that a change in credit score from 600 to 601 would have the same effect as a change from 650 to 651. It's just hard to believe, as you go from no way you're getting approved to, oh, you're barely getting approved to you're definitely getting approved. It doesn't really seem like it would be a linear relationship. All right, the third threat is measurement error. And this one's kind of interesting. For all of my control variables, they come from Lending Club directly. So if there are measurement errors, it should be random. And also all my controls are checked by third parties. They don't just get to type in whatever credit score they want. That comes from a soft pull. So those numbers should be correct. The only place where measurement error could pose a threat is in the geographic indicators, and that is because of the precision problem that I was talking about earlier with the different zip codes. And so it's definitely true that some zip codes that don't have 80% or higher African-American population are included in the African-American indicator. So that would be measurement error. But when you think about it, it is highly likely that which of those zip codes are higher than 80 and which are lower is definitely random. Which means that this does not pose a large threat. It's just something to consider. Fourth, the next threat is sample selection bias, and because my sample includes all loans, this really is not a concern. And then the fifth and final threat is simultaneous causality, which is when causality runs both directions. And it's pretty easy intuitively to know that, a change in your credit score affects your probability of approval and not the other way around, right? Causality clearly does not. Same with the geographic indicators. You don't move because your probability of acceptance changed. Your probability of acceptance changes because you moved. So that is not a threat. And then just to talk about external validity, the goal of this is just to identify the target population where my inferences are valid. And my target population must be peer-to-peer borrowers inside of the US. And this is because there are a ton of regulatory and policy differences between countries in how they instituted peer-to-peer lending and how they regulate it. And there are also different histories of redlining. So HOLC maps weren't even drawn in other countries, and there just might be different histories as far as what geographies have been redlined and what haven't. So in order to extend this study to other countries, I think you would have to find a platform in another country and design a methodology based on the geographic redlining history of that country. And just to come full circle and finish off here with the topic of alternative data, basically all of my models, the interest rate model is linear regression, all the other models are logistic regression. I have low pseudo R-squared and R-squared values for all of my models. And what this means in general is that the data that I'm using isn't painting the full picture of what's going on. And I know that Professor Nodell, you had asked in your thesis comments about what other potential forms of data they could be pulling. And nobody knows for certain, but I read a paper that listed utility payments, withdrawal and deposit information, insurance claims, bank account transfers, internet use, mobile phone use, occupation and identity details. So, it's kind of prying eyes type of stuff. And I think this is growing at such a rate, that it's kind of crazy. But these are some of the types of data that these financial tech firms are starting to pull in. And the main reason that I think alternative data is an important, not really conclusion from this study, but just an important thing that I've realized throughout this study is that it is really, really hard to draw conclusions about where discrimination is coming from if you aren't able to model how somebody is making decisions. So while Lending Club provides all of these very, very good control variables that can control for creditworthiness, you can't do the modeling that they're doing with those variables. And so it's very, very hard to understand exactly where this discrimination is coming from. So I found, discrepancies pretty much across the board, but it's hard to dig deeper than that without having a little bit more of an understanding of what data they're using and how they're using it. As these common metrics play less and less of a role over time, it's just going to be harder and harder for good research to be done. And I think, reporting requirements are absolutely needed in this industry. And that's all of my slides, but I just thought I'd finish with a quick note. I didn't even know this until pretty recently, but Lending Club shut down their peer-to-peer platform at the end of last year. And they are going through a merger, and they are becoming a full-fledged financial tech bank. And basically what they said, you can still get a loan from them, you just can't invest in loans. So now they're a bank like any other bank, as opposed to allowing investors to fund these loans. And, this doesn't really say anything about redlining, but I think it does suggest some stuff about, hey, maybe this model wasn't quite as much of a breakthrough as people originally thought, right? The fact that it's no longer economical for them to be making these loans with investors, I think it's a scalability problem partly. I think, you just reach a point when you're growing so fast that you can't originate that many loans directly on the backs of retail investors. So I think, they were the largest player in the United States, and I think we might see this become more of a niche product as these firms realize that, maybe banks were doing it this way for a reason, and I can't have growth and, continue with this model at the same time. So that's just an interesting, I did not expect that they would be shutting down, but I found out about that a few weeks ago. So that is my presentation. Thank you, guys.
Yeah. Thank you so much, Colin.
Yeah.
So, I don't know why there's feedback. Strange. Trying again? Oh, that's weird.
People should turn off their mic, not use.
Yeah, I'm not sure quite what's going on there. Okay, everybody's got it off, right? And Professor Gibson, you're no longer connected. Oh, it's gone now. Okay. So as the external committee member, I chair the meeting, and now that we have everybody here, I just wanted to welcome you all, of course, and also to thank Colin for doing such a tremendous job. And I'm sure that the first time you heard the word thesis defense, it sort of struck perhaps a little bit of terror in your heart. But what I have found is that for good students like yourself, a defense is actually this amazing moment when you have a bunch of folks committed to giving you feedback on your work, right? And that's actually, I can say now after doing this for 25 years that that's actually kind of rare and special. It's really an amazing moment when you get your work gets a lot of really engaged attention, and so it's maybe hard to savor in the moment, but it really is a special moment. So. So the protocol is that we open this to public questions first, which would mean Tracy, and then we will ask you to excuse yourself, and we'll have the committee questions for Colin. So do you want to ask a question?
No, thank you.
Okay.
I'm good. It was such a
Okay.
joy to just listen to him present, and
Sure,
thank you
of
for
course.
letting me join you.
That's fine. Yeah. Well, thank you very much. And I'm sure Colin will be in touch with you later today.
Yes, thank you.
Thank you, Mom.
Okay. Nice to meet you.
Thank you. Nice to meet you too. And thank you all for the great work you've done with Colin. I really appreciate it.
That's great.